Hello, and I hope you all are having an amazing day. This is Eric Spotswood, Regional Manager with Prosperity Home Loans. I'm here to talk about assumable loans. I know the old adage that you shouldn't assume because, well, I'm not going to go there because I'm in polite company right now. But what is an assumable loan, and is it a good idea or is it a bad idea? So basically, when you're looking at an assumable loan, what I'm saying is I am taking over the terms and conditions of a current loan that's out there. So if I'm a seller of a home and I have a loan, I can actually give that loan and the remaining terms and conditions to a buyer that's taking over that home. So they can assume the payments, much like subletting a home. So I'm going to move right into the loan and continue to make payments just like I was the original holder of it. So what are some important things to know? Well, one, it's basically just available for government loans, FHA, VA, USDA types of loans. It's available in some small pockets of conventional loans, but really it's available on ARM products when they become adjustable. So it's a time where really, I'm assuming it doesn't make a whole lot of a sense because then you're just getting market rates anyway. So you're mostly looking at your government types of loans. So what it is you're still going to go through a normal approval process. So I can't go in and say, I can't qualify for a loan, but I'm going to go ahead and assume this other one. I still need to make sure that I can qualify for a loan. They're going to look at my income. They're going to look at my assets. They're going to look at my credit. So there are still requirements that I'm going to go through to make sure that I am eligible for it. So what was the pro? Why should I do it? The real pro, especially in an environment like this, is I can secure myself into a prior rate. So in an environment like we're in now, where rates have basically doubled since the end of last year, if someone has a note and it's at 2.5% from last year, I can slide right into that 2.5% note and not into the mid fives, probably pushing sixes here as this year is going on, note where it is today. So that's a huge plus. So what are the cons to that? Well, one of the cons can be that they may have already put down a lot of money into that home. So say I bought a house, we'll use an example, for $200,000 and I had a loan of $175, and now the home's worth $300 and I'm making that purchase. Well, I can still only assume the balance. So I'm assuming the $175. I still need to come up with, in this example, the $125 difference. So I can't go back and increase that loan if I'm looking for a minimum down payment or I'm looking to have the least amount out of pocket as possible. Then this might be a little tighter than your normal scenario because it's going to put me in a position where I can only take over the current balance and I need to come out of pocket for the rest. So there are other subsets, things that are important to know for your veteran clients that are out there. If someone assumes a VA loan, it does not free up the eligibility for that veteran. So if that veteran is looking to move into a new home using their VA eligibility again, it is going to be slightly encumbered based on the loan that's out there today. So that's an important factor for them to be aware of as well. But is an assumable loan great? It could be. You're getting into the interest rates that they were in before, which in today's environment could be a fantastic thing. I hope this helps everybody, and I hope you have a fantastic day. Take care.